Today, I want to talk about the managerial accountant's role in corporate governance. And the corporate governance, when defined broadly, is really just setting up conditions within a company such that the managers of the company can manage it very effectively. And the reason that managerial accountants play such a big role in the company in this one area where corporate governance is really important is over the information which we need to ensure that um, is reported very correctly, and the managerial accountants basically end up becoming the guardians of information. So, if you think about it, we have a lot of information here. This information can be reported to multiple places, and in this course, we are really focusing on internal reporting. So, it could be reported to internal managers, it can also be reported to external users like stockholders or creditors, and it's also information that's reported to the board of directors. And the effectiveness of the board is a primary component of good corporate governance. You need an effective board. The board basically ensures that the managers of the company are working in the interest of the stockholders of the company, the external users basically, and they need information to make decisions and to evaluate whether that's happening effectively. So this course really deals with using information for internal decision making for internal managers. And we said that it's not really regulated. You should still understand that a managerial accountant is really the guardian of all this information. This information could be internal, or it may be the information that is reported to the board. It could be information that's reported to the stockholders or creditors and financial statements, and the managerial accountant is a guardian of all that information. Alright, so in this example, I want to show you how misclassifying a cost can impact the financial statement. And, and, I, and so I got four transactions, and we just want to look at how these affect our financial statements. Let's talk through these transactions first. And we're going to look at two scenarios. We're going to look at one scenario where we classify the cost correctly, and that's going to be basically the scenario one right here. And then there will be another scenario where we misclassify the cost, that's going to be, and let's call this scenario 2. Let's start with just the scenario 1. Let's go through these four transactions. So it says number 1, we acquired 12,000 cash from issuing common stock. So the company starts out with 12,000 cash, and then in event 2 it says we incurred 4,000 of cost to design its product and plan the manufacturing process. So we spent 4,000 cash on designing and planning. And we know that this is an upstream cost, and we already talked about upstream costs, and we said that they're typically expense. So if we classify this correctly, we would expense it as a part of selling and admin costs. Then event 3 says incurred product costs, material, labor and overhead of 8,000, and that was used to make 1,000 units. And we know product costs typically are dumped into the inventory account until they're sold, and their expense is cost of the goods sold. So in this case, we had 1,000 units of which were available for sale. And then in event 4, it says we sold 700 units for $18 each. So we sold 700 units, and that means what was left over in ending inventory, let's call it EI, we had about 300 left over at the end of the period. So of these 1,000 units that we produced, we sold 70% and 30% was left over in ending inventory. So okay, let's look at the financial statements. Under scenario 1, where we recorded everything correctly, we have sales revenue of 12,600. And that was just the 700 units that we sold right here times $18 a unit. And it costs, and the cost of goods sold is just going to be the 700 that we sold, and we know that these units cost $8 a unit. We have 8,000 of product cost to divide by 1,000 units. So these guys cost $8 a unit, and we sold 700 units. So our cost of goods sold is 5,600, and you can see that right here. And then that would make our gross margin 7,000, and then we would have selling and administrative expenses. This was my upstream cost, the design and planning of the manufacturing process of 4,000, giving me net income of 3,000. And then for the balance sheet, the company would have 12,600 in cash. And that's the cash it got from selling the product, assuming that all the sales were cash. And that's him and that's his inventory at 2,400. And that inventory number came from these 300 units in ending inventory times $8 a unit. So it's 2,400 in ending inventory. This gave the company 15,000 for total assets, 12,000 from issuing stock, and retained earnings were 3,000. The retained earnings was just the net income of 3,000 for the period right here. So total stockholders' equity was 15,000. So this is assuring that all the costs were classified correctly. Now let's say that the manager misclassified the cost. Let's say that instead of classifying the cost in event 2, this design and planning cost, instead of expensing, let's say the managerial accountant misclassified it as a product cost. So it was classified as a product cost, so it's basically part of inventory. Let's look at what would happen to the financial statements. So we know the product cost. It goes into inventory, so this $4,000 of design and planning cost, it was part of event 2. If we classified it as product, we go into inventory. So there would be an additional 4,000 in inventory, and then we know any part of that when sold would be an expense. We know that in this problem 70% of the inventory was sold. So that means 70% of $4,000 um, were additional product costs would go into cost of goods sold. And 70% of 4,000 is 2,800. So that would come out of inventory and would go into cost of goods sold. And so ending given inventory would increase by 1,200. And so notice if we classify this $4,000 cost as a product cost, inventory is going to be 1,200 higher and cost of goods sold is going to be 2,800 higher. But we will have no selling and administrative expenses because it wasn't an expense. It was classified as a product cost. So let's look at the financial statements. So the revenue would be the same. Cost of goods sold would go up from 5,600 to 8,400, and that's a $2,800 increase. Gross margin would then go down. Under this scenario, there is no selling and admin expense because this cost was not expense and was just a product cost. So the net effect of these things is that the net income goes up to 4,200 and it actually goes up by 1,200. Because instead of expensing this entire 4,000, we're only expensing 2,800. The other 1,200 is an increase in inventory. So you can see misclassifying a selling and admin expense as a product cost increases in net income. It also has an impact on the balance sheet. Cash should be the same, but notice inventory increases by 1,200. Okay, so now we have $1,200 increase in the inventory, which makes total assets increase. Common stocks are going to be the same either way. Retained earnings are going to increase because net income was higher. Retained earnings in this case is just a net income because we didn't have retained earnings in the beginning and no dividends were paid. So retained earnings was 3,000 and now it's 4,200. That makes up the stockholders' equity higher as well. So you can see how cost classification directly affects our financial statements and that the manager accountant is in charge of cost classification. So it's important to have good governance to make sure that the managerial accounting does not have any incentives to misclassify costs in an effort to manipulate financial statements. And one final thing I want to point out with this example is that this increase in income from 3,000 to 4,200 is only for one period. It is going to occur this period and it will reverse in the next accounting period. So while this accounting period income was 1,200 higher, next accounting period income will be 1200 lower. So over time it will all balance out. The reason it will balance out is because let's say nothing else happens, um, but we sell our remaining inventory next accounting period. If we sell our remaining inventory under scenario 1, cost of goods sold would be 2400. Under scenario 2, cost of goods sold would be 1200, higher at 3600. So since cost of goods sold is 1200 higher, net income will be 1200 lower in the next accounting period. So misclassifying this cost increases the net income for this accounting period. But for next accounting period, it will reverse out, and net income would actually be 1200 lower. Now, just because it reverses out doesn't mean it is not important. Maybe there's some incentive package such that 10% of the net income will be paid out to the managers in a form of a bonus. And so in scenario one, 10% of these 3000, the managers would get 300 in bonuses. And in a scenario two, they get $420 in bonuses. So if the managers are really concerned about their bonus this year, then there is an incentive to manipulate the financial statements by misclassifying the cost.